Welcome back. This is the oil market review for the 17th of February. The oil market continues to attract traders with its latest price action. Despite the fact that WTI is currently in red territory on a weekly basis, at the beginning of the week, WTI reached a new multi-year high price touching $94 per barrel. This report's purpose is to present the latest and most important fundamental topics related to the oil market in order to assist traders with the necessary knowledge to trade with confidence. Along with the fundamental analysis, we will also present a technical perspective of WTI's chart, providing information on important levels to keep in mind. Enjoy the report. We set it off by reviewing the most recent oil market data from the United States. During the past Friday, the Baker Hughes oil rig count figure that was released in the mid-US session indicated active oil rigs had increased by 19 since the previous week. This is the largest weekly increase delivered so far in 2022. The significant increase in active oil rigs can be understood as a substantial increase of demand for the commodity. In the next hour after the release, WTI gained almost $2 per barrel, which in our opinion tends to highlight the market's surprise reaction to the news. Furthermore, the API inventory levels of US crude oil released on Tuesday the 15th showed a drawdown of minus 1.08 million barrels, yet the market's reaction was mild, possibly due to the fact that the figure was minor compared to the previous one. Also, the EIA crude oil inventories figure released on Wednesday, the 16th, displayed a surplus of 1.12 million barrels. As a result, WTI prices dropped almost $4 per barrel in a possibly delayed market reaction in the next hours of the release. The overall understanding derived from the pre-mentioned data could be that with the recent WTI prices reaching above $90 per barrel, it could be very tempting for US oil companies to ramp up production. The news seems to benefit specifically the US shale oil industry. Yet, the new market circumstances may require a more strategic approach by the US oil industry to avoid overproduction and debt suffered in the past years. Geopolitical tensions remain in the market's focus for another week. Of course, the most dominant matter is the Russian-Ukraine situation, which is keeping traders in a wait-and-see position. Even though no major developments have been confirmed so far, the oil market remains vulnerable as a possible escalation could destabilize oil supply, with Russia included as a leading player in the OPEC+ group. However, signs of de-escalation or escalation of the matter can weaken or strengthen oil prices accordingly. Thus, traders should be very careful when engaging the market under these circumstances. On a secondary note, the Iran nuclear deal seems to have resurfaced during the past days, with talks being held in Vienna. Some intermediary European countries suggest that some improvement has been observed, which may be preparing the ground for further compromise. On the OPEC front, criticism over the actual production levels of the group has been made public. The International Energy Agency's head, Fatih Birol, stated that the gap between the oil production target of the OPEC+ group and its actual output needs to be mended. This could be another signal that the oil market currently remains deprived in terms of supply, with the most important oil producers globally being reluctant to support the market as they enjoy multi-year high price levels. Moving now to our technical analysis, please note this is WTI's 4-hour chart. At the moment, WTI is trading just between the R1 91.70 resistance and the S1 87.50 support level. Even though the most recent price action seems to point out a sideways motion for WTI, in our view, the commodity remains in an upward momentum. If the price action is to head lower, the S1 87.50 support level could be engaged as a first move, while even lower the S2 85.75 level can be used as a target for even lower grounds. Please note the S2 is the lowest level reached so far in February. In our opinion, the final support level, currently noted as the S3, 83.60, can be used in a decisive selling trend scenario. In the opposite direction, for the traders supporting the buying side, we may see the R1 91.70 that was tested in the very recent sessions being revisited. Higher, the R2 94 level is the multi-year high price briefly tested during the previous Monday, and could act as a significant make or break point if engaged. Finally, the R3 96 hurdle can be a new target in the scenario of a strong buying trend. Currently, the RSI indicator below our chart remains below 50, as some buying orders may have been removed after the recent surge to higher levels in the past days. Thank you very much for your time and focus. We appreciate your participation, and if you like this video, please feel free to share and subscribe. From everyone here at IronFX, wishes for solid trading.